My name is Elizabeth Abdu.
Hi, my name is Maddie Brenner.
I'm Nick Spurgeon.
Hi, I'm Sean McDermott.
Matt Phoenicia, on behalf of all of us and our team, we'd like to thank you for having us today and putting this event together.
Thank you and welcome. My name is Antulio Bonfim. I am a senior advisor here at the board in the Division of Monetary Affairs.
Good morning and welcome. My name is Thomas Lubig. I'm from the Richmond Fed. I'm senior advisor to the president.
My name is Tom Clickard. I'm from the New York Fed.
Our presentation is called Mindfully Navigating Current Monetary Policy Decisions. Today, we're going to take a look at economic indicators, the dual mandate of the Fed, and how this affects the Phillips curve. We'll take a look at global factors that will be influencing the Fed's decisions. We'll go into an in-depth analysis of the yield curve, a hawk and dove argument, and then finally, we'll end with our policy recommendation. The first part of the dual mandate is to maximize sustainable employment. As we've seen through the U3 headline unemployment rate, that rate is sitting at 3.6% right now, and it is sitting around a 50-year low. While this indicator alone can indicate a strong and tight labor market, when we take a look farther into unemployment, we can see that this remains true. You can see the difference between the green line and the blue line that spread has been decreasing since the recession, indicating that people are becoming more fully employed and re-entering the labor market. And then I also want to draw your attention to the red line, which represents the black male unemployment rate. Janet Yellen has made the argument that towards the end of economic expansions, when the labor market is really strong, that's when low-income and marginalized employees begin to feel the full effects of a tight labor market. And we can see that in 2019, the black male unemployment rate has declined significantly. The next unemployment factor we'll look at is the prime age labor force participation rate. We can see that that has been on the rise since 2014, which represents people are re-entering the labor market after being discouraged. I also would like to point out that that rate is not at the point that it was before the recession, which could indicate that there's still slack in the labor market. The final unemployment indicator we'll look at is the quit rate. The quit rate is at a 12-year high right now, which indicates that people are confident that if they quit their jobs today, they'll be able to find another job. The next indicator we'll look at is GDP percent change. As we can see the recovery that the economy made after the 2008 recession, and we can also see the positive GDP change in the most recent years, but we can also see that that rate is slowing, so we'll have to keep an eye on slowing GDP. This slide takes us into a breakdown of real GDP quarterly. The first panel shows that we have had positive real GDP change in recent quarters, and below that, we can see that that's been driven by personal consumption, which is sitting at 3% right now from Q3 data. But when we take a look at the right side of the screen, that's where we see some concern in GDP growth. So as you can see, investment overall has been down 1.5%. And then if we take a further look at that, it seems to be that business investment has the biggest drag on GDP growth at -3%. The next indicator we look at is productivity. We were hopeful in quarters 1 and 2 that productivity growth was going to be strong and steady, but when we recently received Q3 data, productivity growth was negative for the first time since 2015. This negative productivity, paired with the rising unit labor costs, increases the cost of production to firms, which ultimately will have inflationary pressures on the economy, we believe.
So our second side of the dual mandate is price stability. By this, the Fed aims to keep core inflation at about 2% per year. But as we can see, we've actually only hit this target 2 times over the last 10 years. Currently, we are below target, and core inflation is at 1.7%, so we are looking to see this continue to rise. Next, we're going to look at our long-run inflation expectations, and we see that these have been pretty well anchored at the 2%, but recently, especially in the last year, they have drifted below the target and currently are at 1.74% for the 5-year forward, so this could indicate some concern for the Fed. Now we're going to look at the relationship between the inflation rate and the unemployment rate. So historically, we turn to the Phillips curve, which shows an inverse relationship between these two variables. And we see this because as the economy is growing, businesses are expanding, creating more jobs, then they face increased competition to retain and attract good labor. So as the unemployment rate goes down, inflation has tended to rise. And then we first saw a breakdown in this relationship in the 1970s with stagflation. That was very high inflation and high unemployment at the same time. So currently we're about the opposite of stagflation, with inflation below the Fed's target and unemployment at almost 50-year low. And we see how flat this curve has been, so we're not necessarily seeing the overheating relationship as much as we did in the past. So reasons for this flattening of the curve are the anchored inflation expectations without too much volatility, a strong dollar, which Matt will talk about later, but this can have downward pressure on inflation in the US economy. And then when wages are pushed up, employers now have increasingly more options to avoid paying these higher wages, so they can automate jobs and globalize into economies with cheaper labor and input prices. And then that headline unemployment, 3.6%, that doesn't necessarily capture the full scope of the labor market, since it doesn't include the discouraged workers or the underemployed.
So Maddie and Elizabeth just did a great job explaining the factors and data we're getting from the U.S., but obviously that's not the only thing the Fed needs to take into account when making monetary policy decisions. So we'll take a look at some global factors, the first of which being China, which is obviously an important player in the global economy and a major trade partner with most developed nations. And their quarter-3 year-over-year growth for GDP was about 6%, which is the slowest growth rate they've had since 1992, which is a major concern. And on top of that, we've had a trade war, obviously, for the past few years between both parties' political powers, and that's led to, on the next slide, we'll see a decline in exports, which peaked really about in 2018, right before some of those tariffs were being talked about and put into effect. So we've seen slowdown in exports from the U.S., which leads us also into the next slide, which we can see this possibly spilling over into other parts of the world. So the Eurozone has also had a decrease in exports starting at around about the same time, a negative 3% growth rate there. And going on to the next slide also, there are also other factors in Europe that need to be considered. There's been a 3-year debate in British Parliament about Brexit, and ECB policy also has affected this. Mario Draghi in his last press conference stated that he was maintaining the ECB's policy of a just under 2% inflation target, and that rates will probably remain lower for longer. And what this does is essentially will give, so the lower for longer rates will attract U.S. yields are higher than foreign countries, so that attracts large asset managers and money managers from abroad are seeking the yields on U.S. returns. So they're selling their currency, they're purchasing U.S. currency, buying these assets, which is propping up the price of the dollar, which we see as downward pressure on inflation. And also with all this political uncertainty, we also see that as a drag on business investment, because why would a business invest in fixed property, plant, equipment if in 6 to 12 months' time they're uncertain about the conditions they'll be operating in?
And this brings us to a discussion about the yield curve. The yield curve depicts interest rates on fixed securities over various years to maturity. The yield rates are composed of interest rate expectations as well as a term premium. Naturally, the yield curve is upward sloping, as investors typically need to be more highly compensated for long-term, generally more risky bonds. However, the yield curve can invert when short-term rates are greater than long-term rates, which is important because the yield curve has inverted within the last month. Equally important, the yield curve has inverted for long durations before each of the last 3 recessions. Now, does this flattening or inversion of the yield curve indicate a recession? No, the yield curve can invert due to lower expected short-term interest rates, which can pose a problem for the economy as the market has lower expectations for the interest rates and it displays pessimistic expectations for the economy. However, the yield curve can also invert due to a low or negative term premium, which is not necessarily a problem as businesses are able to borrow at cheaper rates, and this reduces the accuracy that an inversion of the yield curve leads to a recession. Low inflation coupled with a negative term premium can lead to a flatter yield curve than we have seen in the past. And when we look at the data, we can see the 10-year term premium is sitting at negative 1.01%. As Matt mentioned, one reason for this could be the negative rates on long-term European bonds, which creates a higher demand for long-term U.S. bonds as investors search for higher yielding alternatives. The long-term decrease in the term premium that we have seen over the last 20 years can be attributed to greater transparency of Fed policy as well as lower inflation volatility and risk. The more recent decrease in the term premium that we've seen over the last year can be contributed to Europe's continuation of large-scale asset purchases through their expanded asset purchase program. And recently, we have discovered that long-term bonds have provided a great hedge against equity risk, which increases the demand for these bonds. And then when we look at the yield curve today, we can see the inversion has reverted as the spread between the 3-month Treasury bill and the 10-year Treasury bond is increasing. When we look at the 10-year rate, it is currently sitting at 1.8%, which includes the negative 1.01% term premium. If the term premium were 0, this rate would be sitting at 2.8%, which is a very healthy indicator and displays great expectations for the economy in the future. And the yield curve maintains its typical upward slope that we like to see, which shows Fed policy is already taking effect.
So now that we've taken a look at all these different macroeconomic indicators, we have gone ahead and categorized them into the hawk and dove debates. Now for the first major indicator for the dove side of things, we see an upward trending labor participation rate sitting at right about 82.6%. This ultimately suggests that we may not be at our long-run aggregate supply and some form of expansionary policy might be necessary to get us to that potential GDP. The next 3 points are really tied closely together. So inflation is well below the federal target rate of 2%. Expected inflation has been decreasing in recent years due to stagnant inflation, and then also the strong U.S. dollar is holding inflation down. So ultimately, these are all tied to that 2% target rate for the Fed, and ultimately expansionary policy might be necessary to get us to that 2% level. On top of this, as Sean just mentioned, there has been the yield curve inversion, but this is not of a major concern for our team as it has recently reverted since its inversion. And then lastly, for the dove side of things, we've seen investments down 1.5%, which can suggest a pessimistic business outlook, and ultimately expansionary policy might be able to help this number improve. Now for the hawk side of things, one major indicator is the strong labor market. We're sitting at a 50-year low, which is sitting at right about 3.6%. If we were to currently be expansionary, this would suggest that we might be overheating or potentially being financially unstable. Also, as we mentioned before, the yield curve has reversed, and ultimately there's a healthier outlook for the economy going forward. On top of this, global forces are keeping U.S. rates down, and ultimately there's some form of expansionary stimulus already coming from abroad markets. Lastly, the consumption's up 2.9%, government spending's up 2%, and also consistent GDP growth of 1.9% are all signs of a healthy and improving economy. And then lastly, one thing, if we were to be expansionary going forward, there's this deteriorating lending standards in a leveraged loan market. So with lower rates, there's ultimately riskier and more loans being taken, and ultimately a bubble like the 2000 housing crisis could potentially develop. And this ultimately leads us into the neutral rate analysis. So the FOMC currently estimates the real neutral rate to be 0.5%, and if you add this to the core inflation of 1.7%, this puts us at 2.2% overall. If the federal funds target rate now is 1.5 to the 1.75% range, this puts the Fed at a slightly mildly expansionary position. And this ultimately gets into our team's recommendation. So overall, we agree with the FOMC's current mildly expansionary position, and this is due to two main reasons. One, investment spending has decreased. It's down 1.5%. And then also inflation is below the target, sitting at 1.7%. A slightly expansionary position would help improve these numbers. But going forward, we do not believe the Fed should be making any more cuts. That's due to a few reasons. One is that we've seen this reversal of recession indicators like the yield curve. And on top of that, we as a team believe that the benefits do not outweigh the weaknesses, the costs. Overall, there's financial instability and excessive risk-taking costs associated with cutting rates. The benefits obviously would be to increase the inflation and ultimately to increase the investment spending numbers as well. On top of this, there's outside factors that the Fed can influence. These are financial instability, the data lags, the global factors, and slowing growth productivity. Ultimately, we as a team believe we should wait for the data lags and to monitor all these other outside factors before the Fed decides to cut in the near future, and ultimately should refrain from cutting currently. Thank you.
Thank you. So we'll start by asking you a couple questions, and then we'll dig a little deeper into some of the really interesting issues that you all brought up. Okay. So as you know, the Federal Reserve has been conducting a review of its monetary policy strategy, tools, and communication practices, and this has been going on throughout this year with several events around the country. They're called Fed Listen events, right? And as part of these events, many of those have included discussions with community leaders' perspectives on how monetary policy decisions affect their constituencies. So with that in mind, I'd like to put forward the first question, okay? Could you discuss how, if at all, the FOMC's monetary policy decisions of the past decade have affected the distribution of income or wealth in the United States?
Yeah, I think, so the first thing we would want to look at, obviously, is the FOMC is setting interest rates, and that plays a big factor in terms of business investment, a lot of other factors regarding that. So it's the baseline interest rate that banks would make on reserves, and then from there, they set an average lending standard. I think one of the big things we've seen is the spread for, I guess, people that might be seen as higher risk or marginalized is much greater than we've seen in the past. Maybe the Fed could take more action on some of those standards, which I think they have some metrics in place, but and the federal government has some metrics in place. But I think specifically if the Fed were to maybe focus on some of those things more, we could see more marginalized people in society able to achieve better interest rates and then therefore improve their financial conditions.
Yeah, one thing I also would like to point out is that with the recent expansionary policy of the Fed and the hope that inflation will rise more also impacts real wages, which will then have a spillover into just the average worker. And then also pointing out that unemployment rate of marginalized workers is falling, which has had very positive effects on the overall labor market. And so like that expansionary policy and the Fed's policy of the past decade has improved those conditions for marginalized workers.
I think in addition, the lowering rates that the lowering federal funds rate, then it takes account into and spreads into all other rates, like the prime rate, mortgage rates, credit card rates, and it makes it more accessible for all people to be able to have loans and with that lower interest rate accessible to them.
Okay, thank you. Let me follow this up with another question you've already touched upon this a little bit in your presentation. So we know that the US labor market has performed quite well over the past several years, and the unemployment rate is now at 50-year low. How would you explain the behavior of inflation over the past several years, particularly in relation to the FOMC's dual mandate and its inflation objective? So I want you to dig a little bit deeper.
So core inflation currently is at 1.7%, and this is below the Fed's 2% target. So even though we are at that 3.6% low employment rate, we aren't seeing necessarily the increase in the inflation. And this is partly because the inflation expectations are also so low. So when people expect inflation to be lower, they'll put this into their prices. They will increase wages in taking in account to this, and then increase their prices as well. So that's another reason that inflation hasn't taken off, because the inflation expectations are so low.
Since the Fed has set that 2% target and has been running below that 2% target, that does influence the person's expectations of inflation and like the Fed's overall credibility. If they keep undershooting inflation, there's a concern, I guess, from the general public that the Fed maybe isn't going to continue to make that, despite the fact that unemployment is so low. So that's another concern, and that, as Maddie mentioned, like the breakdown of the Phillips curve may be something that we are looking forward in the future.
Yeah, and this is after obviously a long period of rates being so low, which should technically or theoretically at least push inflation upward, and we should have upward inflation pressure, but we're seeing the opposite of that, which is pretty concerning right now. And I think it's just something that obviously the Fed has to keep an eye on, and it's a symmetric 2% target. So because we've been running below 2% for a while, you'd have to compensate for that and make sure that you hit the 2% target on the upside as well. And a lot of people at the Fed have actually stated that in their policy addresses.
But why aren't wages rising? You talked about a tight labor market. Do you have an explanation for that?
Yeah.
I think,
Yeah. Well, wages are rising at 3%, but we're not necessarily seeing that take over in inflation as well, because there are so many factors. But as I said, there's automating jobs now, so they don't have to increase wages as much, even though they face that competition for labor.
yeah, the unit labor costs have just begun to pick up, and with productivity also has historically been increasing. That increase in productivity along with the increase in unit labor costs, those moving together would then not drive up real wages. So it's once the long run aggregate supply begins to slow more, but we still see that rising unit labor cost, so that's when we finally see the spillover of inflation.
So just getting in, you see wages rising and you don't see prices. How is that possible?
Could you repeat that question?
So you see, you just said wages are rising above 2%, and you're not seeing prices growing. How is that possible?
I think that has to do with the data lag too, like the productivity report just came out. Like we learned of the wage increase just 2 weeks ago, and so as we see that, I think that we will see prices begin to rise with wages in the future.
And also, that could just show that we're not at the natural rate of unemployment. We could be below that, which would then lead to, it wouldn't pick up inflation until we are closer to that natural rate.
But I'm just trying to get, what's the ratio between wages and prices?
Usually there is a very close relationship because as firms have to pay their employees more, then they have to raise their prices to keep up with that. So as Elizabeth said, there is that lag that we're waiting to see. So that's why we're looking closely at inflation to see if it will pick up soon in addition with the recent rate cuts.
The cost of production is increasing to firms, so eventually firms can't afford to continue to pay higher wages and without raising their prices also.
Let me follow up on one specific issue. So you pointed out that the FMC has been undershooting its targets in both parts of the dual mandate. Do you see a concern with that if we continue to undershoot? And arguably, it's a beneficial undershoot since the unemployment rate has been so low.
So talking about inflation, there definitely is concern because we want to see that 2% target for several reasons. First, the credibility of the Fed, because if people know that it's the 2% target, so if we want them to trust that the Fed can get there, so then their inflation expectations can follow up as well. And then we want to be at 2% to make sure if we need to get to the zero lower bound, then looking at the Fisher equation, that real interest rate is a combination of the nominal rate subtracting the inflation expectations. So if we have to get to the zero lower bound and we want to get as much power from that in expansionary policy, we want to have negative real rates. So then if we have higher inflation expectations closer to 2%, we'll get more out of that expansionary policy at the zero lower bound.
So if there is still a slack in the labor market, if I understood your point correctly, right? There's still a slack in the labor market. I'm thinking about your policy recommendation, right? Mm-hmm. With inflation below target and slack in the labor market, what does that say about your policy recommendation then?
So our recommendation is really based on the third cut that just occurred a few weeks ago, and we ultimately want to see that third cut and see how it plays into the economy after the data lag. We thought it wouldn't be smart to be overly expansionary in case we overshoot those targets of the 2%, just because we have stimulus coming in from abroad. We have the FOMC's recent decision to cut. If we were to cut further, it could be potentially harmful and shoot us over those targets.
We don't know how low the natural rate of unemployment can fall, and because we're at a 50-year low, there is, while our analysis is that we are not at full employment right now, it's uncertain until looking back to know for sure. So,
and also part of our policy policy recommendation was to also protect the downside risk of financial instability. There's a lot of leveraged loans out there. The average leverage on loans from 2015 has picked up from about 5.5 times to around 7 times now. And this obviously wouldn't cause recession if people are paying back these loans. It's a good sign in the economy. But if some external factor were to happen or something did happen, it'd be much harder to recover from and make a downturn much worse.
So walk me please through the link between monetary policy and financial stability, what you just mentioned. How does that work?
Yeah, so as rates are lower, people that are lending out money, so the baseline rate, obviously, the federal funds rate, everything in the U.S. Primarily is based off of that rate. A spread will be applied for most securities or any sort of loan that's given out. So the lower that rate is, banks are still operating as companies. They still need to provide for their shareholders, and they still need to return profits. So if rates are so low and your interest on your deposits is so low at the moment, how are you going to seek to make more money? You would have to lend out at higher rates and potentially make more risky loans. Now, the Fed has policies in place to make sure that this isn't happening, and they stress test, and banks are actually pretty well in terms of their leverage right now. But where we're seeing this is a lot of corporations have really high leverage on their balance sheets, and that's concerning, at least to our group when we looked into it.
Yeah, and the most risky firms are having the highest debt obligations. So if there were to be a recession, those firms who have the low lending standards got the loans would really see the worst effects of it and would really worsen the effects of a recession.
A little bit more on the low interest rate concept. So the Fed, the FOMC, took down the interest rates to a very low level during the last recession. Could we take this even further? So in other words, what are the costs and benefits, or is it even possible to take the policy rates, normal interest rates, below zero?
Yeah, I mean, there have been a lot of theories and concepts applied to this. Obviously we've seen Europe have negative rates. That is something that potentially the Fed could do by providing negative interest on reserves, which we haven't seen, but it is possible. If the Fed were to charge banks for holding reserves, it could be possible, and then you'd obviously see lower rates from those lending institutions.
Many of the Federal Reserve chair people have mentioned that they don't want to go negative, though, and they've looked at alternate ways of combating a potential recession. So one of those ways that Bernanke specifically had discussed was temporary price level targeting. So once we hit that nominal rate of 0%, we could begin a price level target inflation rate, so steadily increase the CPI at 2%. That would mean that if we continuously undershoot inflation, that the public would be expecting that the Fed's policy would continue to strengthen inflation and get us back to that 2%. So we'd actually see inflation higher than 2%. And that expectation from the public could get us out of a recession faster. It sort of builds in that forward policy guidance that the Fed used in 2008 during the first recession.
So the ECB and the Bank of Japan have tried this. What's their experience? Do you know?
Uncontrollable inflation has happened in the past.
No, I'm sorry.
No, with price level targeting.
So I'm just saying if you've looked at Europe and Japan for lessons to be learned from going to a negative policy rate.
Yeah, well, what we've seen, especially from Japan, is that they've never been able to really get their inflation expectations back to their target, and they've been operating in an area of monetary policy where inflation expectations have just decreased a lot, which is obviously something that we would not want from a standpoint of monetary policy in the United States. And also in Europe, rates have gone negative, and we've still seen a lot of not strong growth from a lot of those European countries. So it could obviously poke some holes in the policy and decisions they've made.
So luckily we are not facing the situation now, but if we were facing a situation where the economy is weak and rates have already been lowered all the way to near zero, and you were advising the FOMC on whether or not to cut rates into negative territory, could you help me just understand, again, I mean, why not? What would be the risks or the costs of doing that?
I think it would really hurt the Fed's credibility in that the past they have talked recently about, or they have talked about how they would never, or not that they would never go negative, but they really don't want to go negative. So if they were to go negative, it could poke holes in their credibility, in which case then when they do their inflation targeting, maybe the expectations don't react the way that they do. So it could affect policy greatly in the future.
In addition, I think so now in Europe we're seeing that savers are coming here for safety and those higher returns. So if we go negative, we could see our savers going into other economies and then going back on our bond demand.
So we're seeing rates be really low in Europe, Japan, and the US. Do you have an explanation of why this seems to be a global occurrence?
We've really seen a big global risk aversion. And when Taylor first started the Taylor rule, the real neutral rate was 2%, but now we're seeing it at 0.5%. So since these great of recessions and downturns in the economies, people see what happens with risk, so they're really saving more and going into safer assets like bonds. So this increase in bond demand over the long term has really brought down the neutral rate, and that's one of these reasons.
Another reason is just the global productivity decrease, which is also dampening real rates.
Okay.
Thank you very much. Thank you.
Thank you.